Two co-workers get the exact same year-end bonus on the exact same day. $60,000 each, sitting in their checking accounts, waiting for a decision. Over the next 20 years, one of them will spend hundreds of hours fixing toilets, screening tenants, and losing sleep over vacant units. The other will do almost nothing at all. And when you finally add up both outcomes, the winner isn't who you'd guess, because the real difference between them was never real estate versus the stock market. It was a single number that neither of them thought to check. Renata puts her $60,000 down on a $300,000 duplex, 20% down, a $240,000 mortgage at a rate in the mid-single digits, roughly where 30-year fixed loans have sat through most of this decade. Her monthly payment lands around $1,600. She finds tenants willing to pay $2,200 combined. On a spreadsheet, that's about $7,000 a year in profit before she's spent a single dollar on anything else. Theo takes his $60,000 and moves it into a total stock market index fund, then sets up an automatic transfer of $350 a month and mostly forgets about it. No tenants, no keys, no story for the barbecue. When people ask what he's investing in, he says, index funds, and the conversation moves on within about 4 seconds. From the outside, there's no contest. Renata owns something you can stand in front of. Theo owns a number on an app, but owning an asset and the actual performance of that asset are two different measurements, and only one of them ends up in your net worth. For the first 3 years, Renata lives the version of landlording people post about online. Rent lands on the first of the month. She's deducting mortgage interest, and she's claiming depreciation. The IRS lets residential rental owners gradually deduct the value of the building over 27.5 years. A real, legal deduction that has nothing to do with whether the property is actually gaining value in the market. On paper, across those 3 years, she's collected more than $20,000 over her mortgage payments alone. Then the real numbers show up. Property taxes run close to $3,600 a year. Insurance adds another $1,800. Using the standard rule many experienced landlords budget by 1 to 2% of the property's value annually for maintenance, she should be setting aside $3,000 to $6,000 a year. Some years for a new faucet, some years for a water heater she didn't see coming. National vacancy data puts the average rental property empty 3 to 4 weeks a year, and an empty unit isn't just lost rent. It's cleaning, listing fees, and a weekend spent showing the place herself. Add it up, and Renata's true cash flow after every real cost isn't the $7,000 number from the spreadsheet. Most years it lands somewhere between roughly break-even and a few $1,000s in the red before she's counted a single hour of her own time. That gap between the number people brag about and the number that actually shows up in the bank account is the part almost nobody mentions before you sign a mortgage. I'm John. If you're enjoying this breakdown and want more evidence-based finance documentaries that help you make smarter money decisions, subscribe to this channel. Theo, meanwhile, isn't managing anything. After 3 years, his account shows roughly $93,000. His original $60,000 plus contributions, compounding at something close to the long-run historical average for a total U.S. stock market index fund, which has hovered around 9 to 10% a year over the last century. That average hides some brutal stretches. In 2008, the market fell by roughly 37%. In March of 2020, it dropped about 34% in a matter of weeks. Investors who panic sold during either of those months locked in the loss for good. Investors who did nothing recovered and kept compounding. That single decision, sell or hold, has shaped more people's long-term returns than any stock they ever picked. And unlike Renata's rent checks, a total market index fund pays a dividend yield of a little over 1%. Nowhere near enough to live on, which is the trade-off for not managing anything at all. By year 10, the comparison gets genuinely interesting. Renata's duplex, appreciating at a realistic 3.5% a year, is worth somewhere around $423,000. Her mortgage balance has slowly worked down to roughly $206,000. Subtract one from the other, and her equity sits close to $217,000. Built not from cash flow, but from tenants slowly paying down her loan and a decade of ordinary appreciation. Theo's portfolio, fed by nothing but that original deposit and his $350 habit, has grown to somewhere around $215,000. They are, at this point, almost dead even. One of them got there through leverage and labor, the other through patience and diversification, and both are miles ahead of where a savings account would have left them. This is where real estate's one genuine superpower shows up: leverage. Renata controls an asset worth over $400,000 using $60,000 of her own money. Theo controls exactly what he put in and nothing more. When property values rise, that leverage multiplies Renata's gains in a way the stock market can't replicate without borrowing on margin, which carries its own serious risk. It's a real part of why real estate builds concentrated wealth for people who do it well, and why it destroys people who buy at the wrong time with too much debt. It's also worth saying plainly, if Renata ever hands the day-to-day work to a property manager instead of doing it herself, that typically costs another 8 to 12% of the collected rent, which quietly erodes the exact cash flow that made the deal look attractive in the first place. Real estate carries other structural advantages most first-time investors don't fully appreciate. Depreciation shelters her rental income from taxes every year, even while the property is likely gaining value. And when Renata eventually sells, a 1031 exchange lets her roll the proceeds into a new property and defer the capital gains tax she'd otherwise owe. Not eliminate it, defer it, sometimes for decades, as long as she keeps exchanging into new real estate. That's a tool stock investors simply don't have outside of a retirement account. Stocks answer back with advantages that are just as real. Theo's investment is liquid. He can sell part of it on a Tuesday afternoon and have cash by Thursday, something no landlord can say about a house mid-lease. He's diversified across thousands of companies instead of concentrated in one building and one zip code, so a single bad tenant, a lawsuit, or a local housing downturn can't wipe him out. And every dollar Renata sinks into a surprise repair is a dollar that stops compounding somewhere else. The quiet opportunity cost that never shows up on a spreadsheet. By year 20, Renata's property is worth somewhere near $597,000, with a mortgage low enough to leave her holding roughly $459,000 in equity, plus 2 decades of rental income that, in most years, mostly covered its own costs. Theo's portfolio, powered by 2 uninterrupted decades of compounding, has grown to somewhere around $594,000, quietly pulling ahead of the leveraged asset without a single mortgage payment or maintenance call. And here's the detail that changes everything. If Theo had simply raised his monthly contribution from $350 to $500, the same way Renata might raise the rent, his 20-year total would climb dramatically higher, because in an index fund, every extra dollar goes straight to work. In real estate, extra money usually means another mortgage, another tenant, and another set of 2 a.m. phone calls. None of this means one strategy beats the other. Real estate tends to win when the rent-to-price ratio is genuinely strong, when someone treats it like an actual business. Screening tenants, budgeting for repairs, keeping real cash reserves instead of a hobby, or when a strategy like house hacking lets an owner live for close to free while building equity. Index investing tends to win for people who want their money compounding without a second unpaid job attached to it, who value being able to reach their cash without listing a property, and who would rather own a small slice of thousands of businesses than the entire risk of one building. Renata and Theo both believed on day one that they'd made the obviously smarter move. 20 years later, the math says they were both roughly right, and both were missing half the picture. The real trap was never real estate versus index funds. It was making the decision off one number, the rent check or the return percentage, without ever accounting for the maintenance, the volatility, the taxes, and the years it actually takes for compound growth to become visible. So before you decide which of these two you'd rather be, ask yourself the only question that actually determines financial freedom. Are you willing to hold on through the boring, invisible years? Because both paths ask you to.